When we talk about core auditor responsibilities in Denmark that every business owner should be aware of, we are really talking about two things: compliance with a well-defined legal framework and the creation of reliable, decision-useful information for owners, boards and stakeholders. In Denmark, statutory audits are governed primarily by the Danish Financial Statements Act and related regulations, and these set clear expectations for what an auditor must do, and just as importantly, what they must not do. As a business owner, your starting point is to understand that the auditor's primary responsibility is to express an independent opinion on whether your financial statements give a true and fair view in accordance with the applicable financial reporting framework. This is not a guarantee that every single transaction is correct, but rather a professional conclusion based on evidence that your accounts are free from material misstatement, whether caused by error or fraud. To reach that opinion, Danish auditors are required to follow international standards on auditing as adopted in Denmark, which define a structured process. They must plan the engagement, assess risk, understand your business and internal controls, perform testing, and then evaluate the results. Practically, this means they will review your accounting policies, test significant transactions and balances, verify the existence of key assets and liabilities, and assess whether your disclosures are complete and transparent. Another core responsibility of the auditor in Denmark is to maintain independence and objectivity at all times. Independence is both a legal and ethical obligation. The auditor must not have financial interests, close relationships, or other conflicts that could compromise their impartiality. They are also restricted in the types of non-audit services they can provide to audited entities, particularly larger companies, to avoid situations where they would be effectively auditing their own work. As a business owner, this means you cannot treat your auditor as an outsourced finance department. They can advise within clear boundaries, but they cannot take over management decisions or design and operate key controls that they later audit. A third area of responsibility is the auditor's duty to obtain sufficient and appropriate audit evidence. Under Danish rules, the auditor is required to design audit procedures that respond to identified risks in your business model, industry, and control environment. They may, for example, confirm balances with banks and major customers, physically inspect inventories, review contracts and board minutes, and analytically compare current year figures with previous periods and budgets to identify anomalies. If there are areas where evidence is difficult to obtain or where management estimates play a big role, such as valuations or impairments, the auditor must apply heightened professional skepticism, challenge assumptions, and where needed, seek external expertise. The auditor also has a responsibility to communicate clearly with those charged with governance, typically the board of directors or supervisory board, and indirectly with shareholders. In Denmark, this includes presenting the audit report, highlighting key audit matters for larger entities, and, where relevant, discussing internal control weaknesses or significant risks identified during the audit. While the formal audit opinion is public, much of the value for you as an owner comes from the more detailed and often confidential discussions and management letters that accompany it. These communications are designed to improve control, reduce risk, and enhance the quality of your financial reporting over time. Importantly, Danish auditors also carry a responsibility related to fraud. They are not responsible for preventing fraud. That remains the responsibility of management and the board. But they must assess the risk of material fraud, design procedures to address it, and respond appropriately if they identify indications of fraudulent activity. If they discover or strongly suspect material fraud, they are obliged to report it to those charged with governance and, in certain serious cases, to relevant authorities. This legal and ethical obligation means that transparency and cooperation with your auditor are not optional. Withholding information can put your business and you personally at significant risk. Another core responsibility is compliance with laws and regulations that affect financial reporting. While auditors are not legal advisors, they must consider whether breaches of company law, tax rules, or other relevant regulations could materially impact the financial statements. If they identify significant non-compliance, they have a duty to evaluate its effect on their audit opinion, and in specific circumstances, to escalate the matter beyond management. For you as a business owner in Denmark, this reinforces the need for robust governance, proper documentation, and timely consultation with advisors when facing complex transactions or regulatory changes. Danish auditors are also required to document their work thoroughly and retain audit evidence for a prescribed period. This documentation obligation is more than an internal formality. It underpins the reliability of the audit and allows for regulatory inspections by the Danish Business Authority and other oversight bodies. From your perspective, this means you should expect structured requests for documentation, clear timelines, and a disciplined approach to how the audit is executed each year. Finally, the auditor in Denmark has a responsibility to contribute to the overall transparency and trust in the market. By issuing a clear, well-founded audit opinion, and by flagging going concern issues where relevant, they help investors, lenders, suppliers, and employees form a realistic view of your company's financial health. If there are uncertainties about your company's ability to continue as a going concern, perhaps due to liquidity challenges or significant strategic risks, the auditor must evaluate management's plans, challenge their assumptions, and determine whether an emphasis of matter or a modified opinion is necessary. For you as a business owner, this is a strong incentive to engage early with your auditor on strategic changes, major financing decisions, or restructuring plans. In practical terms, understanding these core responsibilities should shape how you work with your auditor. Provide complete and timely information. Ensure that your accounting policies are clear and consistently applied, and view discussions about internal controls and risks as an opportunity for improvement rather than mere compliance. Recognize that the auditor's independence is a legal requirement, not a barrier to collaboration, and respect the limits on the advisory work they can perform. When you align your governance practices and financial reporting processes with these expectations, the audit ceases to be a once-a-year obligation and becomes an integral part of how you manage risk, build credibility, and support sustainable growth in the Danish market.